Good morning, everyone, and thank you for joining us today. We're very excited to be hosting today's January year-end pre-earnings webinar, where we'll be doing a deep dive on tickers across the SaaS, consumer, and other verticals. As a reminder, this call is being recorded. Both the slides and the recording will be shared with all registrants shortly after this session. Before we get started, here is a quick look at how some of our callouts from our Q2 pre-earnings sessions performed. We'll be using the same framework for our coverage on today's call. With that, I'm happy to introduce MD Uden, Nate Friedman, and Zeke Fine, the analysts joining us for today's call. MD, over to you to kick us off.
Thanks, Katie, and thank you everyone for joining us today. Before we jump into the coverage, a quick overview of our signal development methodology. For signal modeling, we take a multi-factor approach, so each signal composite includes multiple predictors. Our goal here is to aggregate the leading drivers of a business across all digital assets, including domains, subsidiaries, and apps. On the data sources and considerations for a signal, this will vary across tickers and broadly across sectors, but generally we leverage segment analysis to capture conversions and checkout activity, subdomains, which are especially helpful for SaaS companies. Client-facing subdomains give us a read into customer expansion, product usage, and churn. And lastly, we factor in apps, including MEUs and app downloads. And once we have built an index composite using these data sources, we continuously monitor and update to reflect any changes in the business and relevant corporate catalysts. And lastly, before we dive in, some disclaimers. We are forecasting reported KPIs, not the stock price. All signals are presented on a constant currency basis. And lastly, forecasts are based solely on online KPIs. So for any retailers into this coverage with a offline revenue component, online versus offline performance disconnects may lead to greater variance against estimated results. Okay, with that, we can get started. At the start of the year, the launch of Claude Code and Cowork catalyzed concerns that AI would compress SaaS seat growth and accelerate in-house builds. However, the debate has since moderated as displacement has been slower and more selective than expected. At the same time, SaaS vendors are also embedding AI into their own products and adding new features. Looking across an index of 20 SaaS names most cited in the displacement debate, we see dispersion across segments. So vertical SaaS, including Toast and Viva, have remained relatively insulated, with industry-specific platforms proving sticky. On enterprise SaaS, Salesforce remains stable despite the early displacement concerns, and Figma and Adobe remain above baseline, even as MCP functionalities expand and cloud design adoption grows. Some project management tools, however, have been weaker. But AI displacement is most visible across reference and productivity tools. Stack Overflow and Grammarly, for example, declined materially over the last 20 months. For SaaS, we can also look beyond traffic by tracking client subdomain growth, which give us another view into net expansion. So going to the next slide. Here, across an index of 10 enterprise SaaS names, total monthly active client subdomains grew roughly 6% in the quarter, adding about 3,000 net client subdomains. 9 of the 10 names in the cohort grew, led by Snowflake, GitLab, Adobe, and Atlassian. Zoom, however, was lower, although active monthly subdomain count improved sequentially, up 3 points quarter over quarter. Across the cohort, July grew 3.3%, marking the 12th consecutive month of positive net growth. So overall, we have not yet seen widespread SaaS displacement materialize in the web data. There is a moderation across point solution, but vertical and enterprise SaaS continue to show resilience and net expansion. Okay, now moving on to the coverage. Starting off with Salesforce, benchmarking against subscription revenue, our index composed of login visits and app MAUs accelerated 7 points in Q2, signaling LSD upside versus consensus on a reported basis. The monthly index also improved through the quarter, turning positive in June and July. Across core platform usage, Lightning Portal activity held steady, and Salesforce free trial signups accelerated in Q2. Specifically, small business trial activity accelerated to the quarter, indicating a positive monetization read-through for H2. Slack remained positive, helped by developer and integration activity, with cloud integration activity within Slack also moving higher month over month. Tableau, on the other hand, continued to lag. Organic search visits declined 47%, pointing to softer top-of-funnel discovery, and Tableau registration segment fell 15 points sequentially, down 30% year over year. Total Tableau visits were also down 15%, broadly in line with Q1. On Salesforce's AI positioning, Agentforce activity improved, and the Agentforce demo lead generation page launched in February continued to build through the quarter. Salesforce also launched Headless 360 in Q1, allowing its core platform to be accessed through MCP. Headless 360 activity continued to scale, with visits up 80% month over month in July, following step up in June. Okay, moving on to Asana. Benchmarking against revenue, our index composed of login visits and app downloads improved sequentially over the last 2 quarters, signaling an inline Q2, but moderation into Q3. Asana revenue index is measured on a lag. Here, softer trends in March, April, and July suggest slower growth into the second half of the year. Looking at the top of funnel, organic search continues to decline in Q2. Accounts setup activity was down 4% globally, although US activity remained positive, up 3% in line with Q1. However, visits to the purchase landing page following the trial expiration post sign-up declined 23%. On AI-related activity, AI product overview traffic remained roughly flat in Q2, while demo segment visits proxying inbound commercial leads declined 46%. More broadly, project management category growth has continued to slow, with Asana lagging the cohort into Q2, although some comps, including ClickUp and Airtable, continue to grow. Okay, moving on to Snowflake. Benchmarking against revenue, our index composed of client subdomains continued to expand in Q2, indicating L is the upside versus consensus, which is up 29%, though July deceleration on the monthly index points to softer growth in Q3. Top of funnel activity continued to grow in Q2, although we saw some sequential moderation. Sign-up activity remained positive, while core platform engagement through Snowflake app subdomain also tracked higher and sequentially accelerated in the US. Customer expansion also remained positive, with unique client subdomains up 27% in Q2, following 31% growth in Q1. On AI adoption, Snowflake's MCP server launched in Q4. MCP-related activity continues to build in Q2, although growth moderated from the initial post-launch ramp. Snowflake's conversational co-work interface also tracked higher, while Cortex activity continued to expand following a larger step up in Q1. Despite positive expansion and engagement trends for Snowflake, competition from Databricks remains a headwind. Databricks cloud portal traffic grew 34% year over year ahead of Snowflake, while its share of combined portal traffic increased to 54% from 49% in Q1. We're also seeing more direct comparison activity between the platform, with visits to Databricks versus Snowflake battle card page up 70% in Q2. Okay, moving on to MongoDB. So benchmarking against Atlas revenue, our index composed of developer portal visits accelerated 5 points in Q2, indicating L is the upside versus consensus, with moderation into Q3. The Atlas revenue index is measured on a lag, so the weaker exit rate followed by July turning negative points to softer growth in Q3. At the top of funnel, activity remained positive, although we see sequential moderation from Q1 across both new signups and portal engagement. On the AI side, Voyage AI activity normalized through the initial launch ramp, while the migration segment, which tracks intent to move existing deployments into Atlas, also moderated. At the category level, database and search infrastructure traffic is trending lower, but MongoDB continues to show relative resilience, declining 7% in Q2, compared with larger declines across Couchbase, Pinecone, and Elastic. Okay, moving on to Workday, which made headlines last week. The benchmarking against revenue, our index composed of application portal visits accelerated 3 points in Q2, indicating L is the upside versus consensus of 12%, with momentum carrying into Q3. Engagement remained positive across both core enterprise workflows and the hiring funnel. On the enterprise side, myworkday.com, which captures HR activity, grew 17% in Q2. On the hiring side, myworkdayjobs.com, which captures the external candidate application funnel, accelerated to 12%. Developer and AI activity also continued to expand. Developer portal visits grew, although sequentially lower, up 10%, and marketplace traffic up 7%, while Sana, Workday's conversational AI and agentic platform, grew 59% quarter over quarter, following a larger step up in Q1. At the category level, recruiting activity continues to expand, with growth remaining positive across major job platforms. Greenhouse, Monster, and Indeed all improved sequentially in Q2. Moving on to Zoom. Benchmarking against billings, our index composed of client subdomain visits and app MAUs remained relatively stable in Q2, indicating LSD upside versus consensus of 2%, with momentum carrying into Q3. The Zoom billing index is measured on a 2-month lag, so the acceleration into June and July supports a stronger read into Q3. Core platform usage remained relatively stable to Q2, while quarterly active customer subdomain trends improved by 6 points sequentially. Across product verticals, Zoom Phone continued to see positive activity, with VoIP phone landing page visits up 18% in Q2, in line with Q1. Zoom's AI segments also continued to build. AI Hub activity more than doubled quarter over quarter, while Zoom Docs grew 5x year over year in Q2. Following the May launch, Zoom Slides, Zoom Mate, and Zoom Paper also saw early interest across the broader AI productivity suite. Here we'll be tracking adoption through H2. At the category level, collaboration traffic softened in Q2 with Microsoft Teams and WebEx lower and Zoom Meet roughly flat. Here, Zoom's new productivity suite could help extend usage beyond meetings into broader workflows. Okay, moving on to Okta. Benchmarking against billings, our index composed of client subdomain page views signals an inline quarter versus consensus of 11%, with Q3 tracking broadly in line with Q2 growth. Top of funnel engagement remained relatively stable across login activity and Okta Verify app MAUs, while trial signups accelerated through Q2. Auth0 signups also turned to positive growth. Customer expansion also remained positive, with total customer subdomains continuing to grow in Q2, although at a slower pace quarter over quarter. Okay, now handing it over to Nate for the next set of names.
Thanks, MD, and hello, everyone. Before diving into some of these companies, I want to highlight some industry-level catalysts that impacted the retail and consumer space broadly. Last month, Amazon reported a strong second quarter with top-line beats across various areas of its business. One component of strong growth had to do with a shift in the Prime Day holiday period from its usual July and into late June. However, when comparing cumulative web visits from this year's holiday shopping period versus last, we actually saw year-over-year declines. This coincided with other third-party data that average order sizes dropped and promotions on products were unimpressive. As other retailers increasingly synced their promotions to be more in line with Amazon's, the more price-sensitive shopper increasingly browsed other retailer websites like with Walmart, Target, Best Buy, Kohl's, and Dick's Sporting Goods seeing year-over-year traffic gains during their respective Prime Day adjacent promotional periods. Increased browsing does not necessarily mean higher conversions, however. When evaluating online conversion web traffic data measured up against Amazon's declines, we saw growth at Walmart, Kohl's, and Dick's Sporting Goods. And then following the Prime Day holiday period and transitioning into July and August, the question transitions into whether the Prime Day holiday momentum that some of these retailers experienced sustains itself through back to school season. An evaluation of web traffic by retailers showcases industry relative winners and losers. While Amazon traffic normalized following its holiday bump, we saw beneficiaries through this period split into two mechanisms. First, some pulled forward promotional demand with sharp spikes and fast reversions like Best Buy. And second, compounding seasonal demand with steady climbs and little reversion like seen with Walmart, Target, and to a degree Dollar General. Others with category-specific relevance, such as Dick's Sporting Goods, also saw durable traffic gains. The back-to-school season is equally, if not of higher importance, among soft lines, and Zeke will provide more details in a little bit with his coverage. Moving on to company-specific callouts and starting on my end with Walmart. A review of broader website visits as well as local same-day delivery service tracking and mobile app MAUs correlates with the company's US revenue when including Sam's Club. Our index on a year-over-year basis sequentially accelerated 1 percentage point in 2Q, and we estimate at least an inline quarter with possible slight upside versus consensus estimates. We already highlighted Walmart as a beneficiary from the Prime Day holiday period, and we see modest year-over-year increase in visitation to the back-to-school page this quarter. Walmart likely continues to benefit from broader consumer trade down, and through our audience interest module, we can see increased cross-browsing behavior to Walmart from specialty retailers across a number of industries, including home and household, clothing, and department stores, to name a few. Broadly, Walmart's growth has increasingly become a story of deepening engagement with its existing customer base as the various investments made a year ago to drive loyalty, membership, and repeat purchase behavior coincided with this trade-down benefit. However, with year-over-year comparisons starting to toughen, the growth story is transitioning towards how long will this runway last. Although growth in web conversions continue to remain stable, we are seeing mobile app MAU growth continue to slow. Also notable, when reviewing sign-up and cancellation web traffic trends to the Walmart Plus membership program, the rate of net adds sequentially slowed for the second consecutive quarter to its lowest rate since a year ago, something worth monitoring moving forward. Switching to Dollar General, our tracker comprised of web visits to the primary website, mixed in with visits specifically to coupon and weekly ads pages and mobile app MAUs sequentially accelerated 8 percentage points in 2Q and accelerated on a 2-year CAGR basis. And we estimate low single-digit growth upside versus consensus's estimate for consumable revenue growth. We reviewed the overlap between specialty retailers and Walmart previously, but moving even further down the value chain and evaluating cross-browsing behavior from Walmart to Dollar General, we saw a step up that began in October of last year that could have been tied to changes in SNAP work requirement implementation as shoppers anticipated benefit reductions and expanded their consideration shopping set to include Dollar General. And this trend has remained consistent since the initial rise. As SNAP category restrictions expand across states with an increase in people losing eligibility into the fall, Dollar General website traffic growth is sequentially accelerating. That said, the growth is much more skewed toward paid acquisition channels such as paid search, display ads, and paid social rather than organic. So then the question becomes, is it worth it? The answer seems to suggest yes. Disaggregating unique visitor growth to the website, new unique visitor growth increased 29% year over year in 2Q, a large snapback from negative growth in 1Q. And the incoming paid traffic didn't bounce, but it converted into owned relationships as well. Web traffic to the account sign-up page increased more than 3x year over year, with a spike in July possibly driven by coupon and deal redemption gating. And account sign-in page visits increased at a strong clip as well, corroborating with strong returning unique visit growth of more than 50% year over year this quarter. Looking forward, the question regarding the impact of SNAP eligibility cuts on lower-end consumers broadly becomes a key question. However, one area that may offset this impact is the company's partnership with DoorDash, which offers online electronic benefits transfer ordering. As benefit restrictions and eligibility cuts squeeze the SNAP-dependent customer, a working channel such as this is one of the few levers Dollar General has to keep those dollars flowing to its own stores versus losing the trip completely. And traffic to DG delivery pages have grown 7x since 3Q25. Switching to BJ's Wholesale Club, we estimate slight revenue growth upside versus consensus expectations when evaluating page views to the primary website and mobile app MAUs. A review of top-line traffic growth data suggests continued strength in total and unique visits with balanced growth between new and returning users. And evaluating that traffic growth by channel, direct traffic increased low teens year over year this quarter, a strong sign of a loyal member base re-engaging at higher frequencies, particularly in an environment where value-conscious shopping behavior is broadening across income tiers. And organic search traffic growth continues to also trend in the high single-digit range, consistent with the notion that new club and gas station openings are building unaided brand awareness over time. Conversely, after running at a 50% growth rate range for the past 3 quarters, paid search channel traffic declined 8% year over year this quarter. This is in line with management's intention to exercise cost discipline and use tariff refunds to fund pricing investments rather than incremental acquisition spend. Visitation to the BJ's membership page remains an underlying demand driver for the company, and while year-over-year growth is decelerating, underlying 2-year CAGR growth is accelerating, suggesting that the membership funnel is compounding on top of an already large gain rather than cooling off. And on top of that, mobile app MAU growth remains strong, a reflection of the various investments the company has made to enhance repeat buying behavior. Finally, with fuel prices hitting heights resulting from the Middle East conflict, BJ's has seen a sharp rise in traffic to its gas category page, with this segment of traffic nearly tripling on a year-over-year basis to over 4% of total site traffic. Given the nearly 500 basis point contribution of fuel to BJ's comp growth last quarter, it is likely that this dynamic will persist as well. That said, when excluding gas segment page views from total page views to bjs.com, we continue to see core sequential growth improvement as well. For Home Depot, our tracker consisting of various items including checkout visits and mobile app downloads and monthly active users correlates best with reported revenue growth when factoring in a 2-month lag. Reason being is that most of Home Depot's orders are for big project items, and revenue is recognized for products that are actually delivered or installed. At the same time, the same customer buying these items likely will buy more supplementary items in upcoming weeks to complete their projects as well. Our index sequentially accelerated in March through May with a two-month lag, and we believe points to low single-digit percentage points of upside in 2Q26. While monthly trends re-accelerated in June and July following a somewhat softer May, current quarter-to-date trends point to a slight sequential growth deceleration in 3Q. From a macro perspective, there are continued tailwinds for the broader home improvement industry, including an aging housing stock and a mortgage rate lock-in where homeowners would rather stay in place and renovate instead of relocating. We're also continuing to see a year-over-year sequential acceleration in traffic to application pages for HELOCs, supporting the eventual potential for more big-ticket projects despite ongoing discretionary-related pressures. Given Home Depot's larger overall pro business relative to Lowe's, it is plausible that the company may be seeing more outsized benefits. From a company-specific perspective, Home Depot expanded its Pro Extra digital workspace earlier this year, turning its Pro site from a transaction tool into a project management hub, including delivery tracking, purchase history, and an AI material list builder. As a result, we're seeing continued strong increase in online traffic visiting the Pro account dashboard page and the order details page within that, i.e., more pros spending time inside the company's own digital workspace, which is exactly the operational partner, not just supplier positioning it has been pitching. More on the DIY side, we've seen strong growth in online order confirmation growth during key holiday periods, including Spring Black Friday in April, Memorial Day, Father's Day, and July 4th. Although May was reportedly soft due to unfavorable weather and our monthly index aligns with this trend, strong momentum around these holiday periods led to a snapback in trends that built through the summer. And for Lowe's, our tracker consisting of various items, including checkout visits, as well as mobile app downloads and monthly active users, points to an inline quarter versus consensus revenue growth estimate, though the bar may be raised if Home Depot's performance is strong. Historically, Lowe's higher reliance on the DIY customer, which is more sensitive to economic volatility, and weather disproportionately impacts the company more than Home Depot. Even though weather conditions in May were unfavorable and big-ticket discretionary remains a pressure point, evidenced by continued declines in visits to categories like appliances and flooring, top-line web traffic growth sequentially accelerated on both a 1 and 2-year CAGR basis, and online confirmation visits were strong through the quarter with partial contributions from holiday periods, including Memorial Day, Father's Day, and July 4th. A large driver of this was the step up in paid acquisition, with incoming traffic to Lowes.com via the paid search channel alone accounting for roughly 40% of Lowe's traffic growth this quarter, more than double the next largest contributor. Nonetheless, while Lowe's is paying for a large portion of the traffic, it is also converting. On the pro side, Lowe's has invested a lot towards expanding its presence over the last few years by expanding its Salesforce, adding a rewards program, developing AI tools, and acquiring companies to drive market share in this fragmented market. And we could see some of those initiatives continuing to build. For example, visits to the Pro order tracking page sharply increased year over year this quarter, as well with notable step up in July, and this could be tied to a new material list AI quoting tool that was launched in late May. Switching to RH. Our monthly index evaluating broader unique visits as well as conversions sequentially accelerated 11 percentage points this quarter, and therefore leads us to estimate low single-digit percentage points of upside versus consensus expectations in 2Q. Our index correlates with reported revenue when factoring in a 2-month lag, given there is a longer spend consideration for these oftentimes very high-ticket products, and the revenue recognition upon product delivery may also take time as well. When taking this lag into consideration, so evaluating index trends from March to May, our monthly index sequentially accelerated through the quarter, and based on quarter-to-date trends through July, we are anticipating further sequential improvement, higher than current consensus expectations. A large component of the RH story is tied to an elevated backlog and special order balances as a result of tariff-related resourcing and the subsequent timing of when this translates into reported revenue. Evaluating top-line traffic, we are seeing a sequential acceleration in total visits to rh.com in 2Q, which we evaluate as March through May given the lag. We are seeing the same pattern in customers visiting the online catalogs as well. Earlier this year, it was likely that the customer was seeing elevated shipping times upon the start of their checkout processes and may have opted to abandon the cart or defer purchasing to a later point in time. However, Similarweb data suggests an acceleration in top line and catalog pages, with this trend further building in June and July, likely in part to the heavily anticipated global release of RH Estates. And as we migrate further down the conversion funnel, growth rate trends are moving stronger as well, suggesting potential increased comfort with the current delivery windows or a sign that the company is actually working through its backlog. Other things to note, there remains a large interest in prospective customers searching for nearby galleries and interest in eating at their various restaurants. And web traffic in the UK is growing at roughly 2 to 3x year over year in recent months, partly due to an RH gallery launch in London. And ending with Kohl's from my end, our monthly index evaluating checkout visits and mobile app monthly active users sequentially accelerated 20 percentage points this quarter, with underlying strength on a two-year CAGR basis. As a result, we estimate low single-digit to mid-single-digit percentage points of upside versus consensus's revenue growth estimate. We already mentioned Kohl's as a beneficiary during the Amazon Prime Day holiday shopping period, but a few other points to note. Following a website redesign made in mid-September, top-line web traffic and unique visitor growth began to accelerate on both a 1 and 2-year CAGR basis and exceeded 20% year over year in 2Q. And while both accelerated, growth in new unique visitors is outpacing returning uniques by a widening amount, i.e., the company's recovery is currently being carried primarily by acquisition rather than retention. So what's driving the new customers? Well, while most of the channel-specific traffic trends are improving, the rebound has been paid media-driven, which is consistent with management commentary suggesting some of its initiatives and campaigns would pressure near-term profitability. An example would be the Buy Kohl's campaign that it pushed throughout March. In turn, we saw growth in page views to some of these brands, including FLX, Lauren Conrad, and Tech Gear, to name a few, growing more than 3x year over year this quarter. Kohl's has also strengthened its rewards ecosystem as well, and we've seen visits to a rewards composite, including Kohl's Rewards, Kohl's Cash, and coupon-eligible brands also increase nearly 3x year over year this quarter. Rewards page visits accounted for 20% of all of Kohl's website visits, led by various promotional offerings late in the month, likely also coinciding with a very strong back-to-school season. Finally, in late 2Q, Kohl's launched a full AI shopping assistant called Ask Kohl's, which was also deliberately timed with the back-to-school season and is meant to provide personalized inspiration, find value broadly enhance the customer experience, and ultimately accelerate conversions. While early, this initiative will likely have benchmarks to measure up against. The AI tool runs on Google Cloud's Gemini Enterprise for customer experience, the same underlying agentic platform Macy's and Michaels used earlier this year. While online conversion visits are trending in the right direction and growth inflected positive for the first time in a few years, there's still a long runway for improvement, especially as this pace lags the online traffic lifts we've been seeing across proprietary and Kohl's rewards page visits. And that's it from my end, and I'll turn it over to Zeke to go through his set of names.
Thanks, Nate. I'll start with Lululemon, where we're projecting low single-digit upside on what we think they will report for revenue. Part of the upside is a result of what seems like very low expectations, with the street projecting revenue to come in at -3% year over year. Our index, which is comprised of checkout visits across Lulu international domains, has shown steady decline over the past few quarters, down 18% year over year this quarter, 15% in 1Q26, and 22% over the holidays. One key focus for investors on Lulu's performance is North America. Within the United States, our data has shown growth in their conversion rate, which was at 8.3% this quarter, up from 6.2% in 2Q25. Our data has also shown that Lulu's efforts to steer customers towards their sports and footwear products have been successful. Traffic to tennis and golf pages have grown significantly, up 76% year over year for the quarter. Reliance on clearance items continues to be a focus for Lululemon. The company has gone back and forth on whether it is something they intend to lean into going forward. Their We Made Too Much pages were visited in 13.5% of all visits in 2Q26, up from 11.5% last quarter, though that could be in part seasonal. Next, we'll look at American Eagle, where we think the company will report revenue that is close to consensus expectations with a chance for low single-digit downside. Our index consists of online conversions and app MAU, and has shown growth deceleration quarter over quarter, with 2Q26 up 5% year over year after being up 11% in 1Q26. Part of the potential downside is rooted in Aerie. The Intimates brand has continued to grow at plus 16% year over year traffic growth to Aerie brand pages for the quarter, but this is a considerable step down from 1Q26, which saw 30% year over year growth. We've also seen a large ramp up in traffic to their clearance pages, which are up 52% year over year for the quarter. This may indicate that the company has struggled to move some of their full priced inventory. In any event, more traffic to pages for discounted items could potentially limit expected basket value. AEO also has launched a new ad campaign with Sydney Sweeney starting in mid-April. The campaign was focused on denim, specifically jean shorts, but doesn't seem to have matched nearly the same level of buzz as their first campaign with the actress last year. Clicks from related Google searches to AE.com were a small fraction of the original campaign. We'll now shift to Abercrombie & Fitch, where similar to their competitor American Eagle, we think their total revenue will be close to in line with consensus expectations, but some signs point to low single-digit downside risk. Our model looks at checkout visits to both Abercrombie and Hollister websites, as well as MAUs on their respective apps. The index has seen steady growth deceleration over the past few quarters, with 2Q26 up 5% year over year versus 11% and 13% respectively for the previous 2 quarters. Looking at their brands, Hollister has continued to show strength. Online conversions are up nearly 30% year over year for the quarter, with app MAUs growing at a similar rate. Abercrombie, however, has been much more stagnant, with conversions up only 5% and app MAU down 5% year over year for the quarter. Focusing on Hollister, while the overall growth numbers are encouraging, that growth seems isolated to the United States. Internationally, their traffic numbers have been mostly flat. Hollister also has a challenging growth comp after reporting a 19% year-over-year growth in sales last quarter, which will be difficult to approach again. Lastly, an increasing proportion of Abercrombie.com visitors appear to be going to other competitor websites. 21% of Abercrombie visitors also went to AE.com in July. This is up from only 15% in May. Additionally, an analysis of all the softline retailers we're covering showed that Abercrombie.com had the highest potential leakage to Quince.com, the fast fashion retailer that now ranks 4th in total visits within the fashion and apparel industry in the United States. 25% of all Abercrombie visitors also went to Quince in July, a much higher proportion than any of the fashion apparel companies we're covering today. This may indicate that their products are more vulnerable to being replaced by fast fashion. We'll look at Gap next, where we're projecting low single-digit upside on revenue versus consensus estimates. We look at online checkout visits and app MAU for Gap, Old Navy, Banana Republic, and Athleta. Our index has shown growth acceleration quarter over quarter, up 6% year over year in 2Q26 versus only 1% year over year last quarter. A big part of our upside projection for Gap is rooted in Old Navy's strength in the quarter. Both visits to their checkout portal and app MAU are up roughly 40% year over year for the quarter. Old Navy is the highest selling brand of all those in the Gap portfolio, so a strong quarter from them puts Gap in a strong position. Looking at traffic sourced from LLMs like ChatGPT and Claude, all 3 of Athleta, Old Navy, and Banana Republic have seen considerable jump. Visits from Gen AI websites are up 425% year over the quarter for Athleta, 320% for Old Navy, and 190% for Athleta. While this is due in part to the growth of LLMs overall, consumers who arrive to websites from Gen AI websites are more likely to convert. Lastly, fragrances have become a new focus for Gap. They just relaunched a collection of scents from the 1990s rooted in nostalgia. This didn't happen until the very end of July, but there has already been considerable traffic to their fragrances landing page. Though this won't impact sales for Q2, the buzz created by this new product launch seems to potentially add complementary items to consumer baskets, while also potentially bringing in new fragrance-focused customers to the flagship brand. Back to school is an important season for all 4 of the fashion apparel companies we just covered. Similar to the chart Nate went over earlier, we've created a similar one looking at many of the companies who are most impacted by back-to-school shopping, looking at a 14-day rolling average of total visits to these domains with an index anchored to that figure on June 1st. Almost all of these websites' traffic dipped in June, which appears to be a slower time of year in the industry. Of the domains we've covered earlier, Hollister appears to be the clear winner, with average daily traffic on a rolling 14-day average that has gotten 30% higher than what it was on June 1st. Hollister management in the past has referenced back to school as their retail Super Bowl, so it's clearly a focus for them, and they feature a back to school collection. American Eagle has also gained traffic since the start of June, with average daily visits up 19% in early August. They have back to school landing page for women on their website. Interestingly, Abercrombie has gone the opposite direction, with traffic to their website down 11% since the start of June. They have a dedicated kids section with a domain as well, so it is somewhat surprising to not see much of a back to school bump until later in the period. Gap and Old Navy traffic totals are still below the composite to this point, but may continue to accelerate into August, which is when the bulk of back to school shopping occurs. Lululemon.com traffic is also well below what it was on June 1st. This may indicate that the brand continues to appeal more to the adult premium fitness customers than those who are school age, and isn't able to ride the same wave as Nike. We'll now move on to Victoria's Secret, where we're forecasting low single-digit upside on revenue. Our index is made up of checkout visits, app MAU, and international domain page views. Our index was up 8% year over year for the quarter, a small deceleration from 12% in 1Q26. Part of our optimism for VSXY is the success of their Pink brand. Traffic to Pink landing pages and items was up more than 50% year over year for the quarter. Though not featured in our early analysis, this was likely driven in part by a successful back to campus campaign. Traffic to Clear pages is up on Victoria's Secret's website. Those pages also account for a higher share of total visits than in 1Q26, though that could be related to potentially slower months during the quarter. In any event, clearance page traffic share is still well below the other fashion apparel brands we've looked at, indicating that they've been successful in protecting their premium branding. Beauty has increasingly become a focus for Victoria's Secret. Unique visitors to their beauty product and landing pages are up 36% year over year for the quarter. Fragrances specifically have become an important growth lever for the brand, with the company highlighting the success of their Bombshell Bronze fragrance line. Complementary products like these can both bring in new customers while also increasing basket size for those who are shopping for intimates. Next up is Ulta, where we think total revenue will be in line with consensus expectations. We look at visits to their online checkout page, app MAU, and visits to their Narvar package tracking pages, with 92% correlation with the reported revenue on a year-over-year basis. We did see some growth deceleration in our index this quarter, down 5% year over year in 2Q26 versus plus 5% in 1Q26. We've seen a decreasing proportion of Ulta visitors also going to Sephora.com in the same month. That share is down to 22%, which is the lowest it's been in over a year. This could be related to more consumers trading down and fewer Ulta consumers choosing to visit a more premium cosmetics and beauty retailer. Ulta also launched a partnership with Klarna during the quarter. This will put customers in a position to access funds more easily that they can then in turn use on their products. Thus far, the partnership has led to more than 150,000 visits to Klarna directly from Ulta.com. Visitors who make it all the way to the Klarna integration are more likely to convert, so this could be a fruitful relationship for Ulta. Looking at traffic quality, a higher proportion of visits to Ulta.com are coming through direct and organic means. Not only are these visits unpaid, but they also indicate strengthening brand awareness and equity, as well as being more likely to lead to conversions than paid search, paid social, or display ads. We'll finish with Frisia, where we think revenue should be close to in line with consensus expectations. We look at traffic to Frisia.net and Frisia.me, which are patient-facing domains for appointment registration and information access. This model is on a 2-quarter lag, so the relevant months for this quarter are actually November 2025 through January 2026. We did see notable deceleration in our index, down 14% year over year versus plus 3% in 1Q26. One benefit of a lagged index like this one is that we can evaluate company performance more in the future. There was acceleration in June and July, which may point to more favorable results in Q4, and might be encouraging enough for the company to guide to a higher number. While our model looks at traffic to patient-focused domains, commercial activity goes through Frisia.com. While traffic to the commercial domain is down, a higher proportion of that traffic is improving, with more of that coming through direct and organic means. Lastly, Access One is an important consideration for PHR. They acquired the patient financing company in late 2025, which integrates directly with hospitals and providers as well. The patient portal has seen significant traffic decline, but revenue total should nonetheless be elevated with the company in the fold. Thank you so much for joining us. Our next webinar will be in October when we'll look at Q3 earnings previews, and we hope to see you there.